webinars that we're doing to provide the Tri-County area folks with information that is helpful to all of us as we look at returning to work, doing it safely, and looking at the various impacts. Today, I'm just absolutely delighted to welcome Shane Theriot. Shane is a personal financial advisor with Edward Jones. He's got over 14 years in banking and personal advising. A native Texan, he did duck out of the state for a couple of years while he went to school and did some jetting around. But otherwise, this man is born and bred here in our area. He tells me he's 30 miles down the road from Katy in Columbus, and I am just delighted to welcome. So Shane, Shane, it's so nice to have you here today. And welcome not only to the folks that we've got on the webinar, but we're also broadcasting live on Facebook.
Well, thank you, Janine. I appreciate you having me on and asking me to speak on behalf of the Chamber and the task force. I wanted to give a little update about what has happened in the markets and the economy, what we're in right now, and where we're headed. So it sounds three-pronged. We actually separated into 4 phases to recovery at Edward Jones from our perspective. That's repricing, refooting, reopening, and then recovery. And I'll break it down into a little bit of each. And then towards the end, we'll have a Q&A option. So anyone who has questions can certainly ask, and time permitting, we'd be happy to get to those. So the first phase is repricing. Generally speaking, what that is was the market correction that we experienced in mid-February. If we look at the numbers, February mid-month, we were at a high on the Dow of 29,551. And then March 23rd, we dropped to a low of 18,213, which was equivalent to about a 38% drop. It was the quickest pullback in U.S. recorded history, but not the largest. In our most recent history, most people will remember the 2008-2009 mortgage crisis, and that was a 50% pullback in the market. Generally speaking, a bear market is defined as a 20% pullback in the market. So we are definitively in a bear market, but more importantly, as of June 8th, this month, we have officially been told we are in a recession. It doesn't exactly meet the definition of a recession, which is a fall in GDP for 2 consecutive quarters, because we're not at the end of Q2 quite yet. We'll get those numbers when July hits. But it has been determined that we are actually in a recession. During the repricing phase, we saw a skyrocket in the number of unemployment claims year to date. That's over 40 million now. We get new unemployment claim numbers every Thursday, which is why we generally see some bounce in the market on Thursdays. And the approximate return to a new high from the low here, meaning from recessionary indicators or March 23rd's low, has generally historically been approximately 24 months. So we would be looking forward in the last phase to approximate recovery the last 6 months of 2021, the beginning of 2022, but we'll get there during the recovery phase. I do want to give a reminder out to everyone. If you currently work with a financial advisor, we ask you about your comfort with market fluctuations. We refer to that in our world as risk tolerance. I can tell you the best test of risk tolerance is an actual down market like we experienced in March. So keep that in mind. If you need to revisit your comfort with risk, you now know what a very large pullback in the market is if you've forgotten what 2008, 2009 was like. The second phase in our 4 phases to recovery is refooting. And refooting, I would define as, where is the bottom? Have we reached the bottom? And the bottom meaning multiple things. Was March 23rd, where the Dow was below 19,000, the low? Of course, we don't have the crystal ball in the investment world, and this time is definitively different. The reason the market was pulled back had nothing to do with what was occurring in the economy. It was because of a virus and subsequent pandemic that we have come to find out as our new normal. What we would expect to see when Q2 numbers come out in July would be a peak in the number of cases, which we're seeing, and some counties, states, and local governments have taken action. Specifically our own county here, Harris County, and Colorado County, where I live, masks are once again required. They've become the new norm again. During this refooting period, we've also seen a fiscal and monetary response on levels we've never seen before in amount and in timeliness. Both were the quickest responses in US history to any market pullback. So the Fed, which is our monetary stimulus, has, that's Jerome Powell, he has agreed to keep Fed lending rates at or near zero and plans to leave them there for an extended period of time with no definitive time frame in mind right now. That's to keep lending affordable for you and I, so we'll go out and buy cars and houses to stimulate the economy, and to keep inflation low. And I would say it's at historical lows, dipping into deflation almost, but at the end of May, inflation was hovering around 0.03. The Fed is comfortable with inflation being around 2 to 3%, and in January it was just under 2.5%. For fiscal stimulus, we saw that in the form of payments to everyone who qualified, the $1,200 or slightly less, depending on your income and other circumstances. So both of those things occurred very quickly, and I'm quite proud, to be honest with you, because what both of those things have done is suspend the markets from free fall, meaning falling further than what happened on March 23rd. There is a potential for additional congressional stimulus. The Fed is offered to buy corporate bonds. I mean, they're no holds bar on what they're available to do. They're just short of printing money at this point. And we also saw at the end of Q1, and we expect to see nasty numbers as far as corporate earnings are concerned for the end of Q2, worse so than at the end of Q1. We would also expect to see some pretty nasty end of Q2 unemployment numbers, with unemployment annualized around 20 million actually receiving benefits right now. The third phase is reopening, and that's where we currently are. We've seen a phased-in approach at some states, some leading the way, and some of those leaders, we're seeing those increased number of cases now. And we also have the laggards who are slow to reopen, but are starting a reopening process. So we're seeing it in the economy. As people are getting back to work, we've seen some positive signs where for example, unemployment claims have dropped from their highs of over 6 million in one particular week. Now they're leveling off, and I'll be quote unquote with leveling off. There has been a resumption of consumption by consumers, and I think that a large part of that is just pent-up demand being unleashed because people are actually feeling comfortable getting back out there. We've seen retail numbers that we've never seen before as far as increases in revenue, which is expected because people were pretty much shopping online because they weren't comfortable leaving home or were told not to leave home. We're also seeing positive movements in the markets. So from the 18,000 mark to what we're seeing today in the S&P and the Dow, we've come a long way, and it's been very quick. Most people have alluded the recovery to shapes of recovery that mimic letters in the alphabet, like V-shaped, which is what 2008, 2009 was, very quick recovery that occurred 18 months or less, or U-shaped recovery or W-shaped recovery. We'll talk about that as we get into the recovery phase, but we have seen markets suspended as of late, hovering in nice comfortable territory and recovering pretty much what we saw from back in when Trump was first elected back in 2016. In fact, since June, as of June 11th, the S&P has risen 42% since the March 23rd low in this particular bear market. We have seen some progress on the medical front that started with hydrochloroquine. Took me a while to learn to say that word correctly. As of late, you've probably heard of remdesivir, which is an antiviral that Gilead makes. There have been some very small studies with, is it a cure? Does it just decrease the amount of time that you have it? Most recently in the news, you've probably heard of some corticosteroids, one that's been around since 1962, very cheap, very affordable, $6 for 5 or 6 pills that you take for a couple of days. Also decreasing the duration and maybe the severity that you're having, but those studies have been relatively small. And the one that I'm referencing regarding the corticosteroid actually wasn't even in the US. I believe it was in the United Kingdom. As far as I'm aware, keeping up with the news, I'm not aware of any human trials for vaccines yet. So where we are during this reopening, we were afraid of a possible second wave, and we are currently seeing increase in numbers in certain states, and those would be the states that are leading the way on their multi-tiered phased-in approaches. Specifically, like with Texas, I believe we're in phase 3 at 75% capacity in some establishments, which we're seeing increase in numbers as well. So obviously that resulted in masks being required again and a reminder about social distancing. In the next phase, the third phase, I'm sorry, yeah, a little bit more here. Consumer spending while we're in the reopening phase. Keep in mind that consumers comprise 70% of gross domestic product in the United States. As we spend money, we help the economy because we're buying more, which gets people more jobs, so forth and so on. And so really, generally, we need people to get back to work, stay physically healthy, and start spending money again, which is why the Fed is infusing money and the monetary stimulus and fiscal stimulus that we've been seeing and expect to see more, to be honest with you. We do expect labor markets to continue to improve as people do get back to work and economies continue to open. And we would expect to see additional fiscal stimulus coming from Congress in some form of package. Don't know if that's going to be more money in your pockets directly, like the initial $1,200 or somewhere along those lines, or some additional way that they can infuse money into the economy by putting it in our pockets directly. Some risks that we're going to experience during the second wave that are at least concerns of ours is the second wave potential, and we're seeing a slight uptick in that. Vaccine development. So while this pandemic and virus was the start of this recession, we believe that the vaccine, which will lead to consumer confidence, is going to be the bookend on the backside to help overcome the current situation in the market. With the vaccine, it's not just the development and the logistics of it, it's also how do we manufacture mass quantities and get them distributed, so the distribution chain is going to be an issue across the globe, not just here in our own country. And then some other concerns about the vaccine is because we're trying to develop this very, very quickly. How effective will it be, and how long will the vaccine itself last? We like to think vaccines are indefinite, like we fix the issue, but we don't know that. Every vaccine is going to be different. So something to keep in mind along those lines. Additional uncertainties that we have to keep in the back of our mind are the election. So we knew coming into 2020, regardless of what happened with the pandemic, which basically was a Mack truck hitting us in the face, we knew this year was going to be bumpy as far as movement is concerned, because it's an election year. We're an extremely bitter and polarized, very divisive country right now. And that, as we near the election in November, is going to become more apparent. So keep the election in mind, that if you see volatility in the market, it has something to do with that occurred in the news that particular day, but it could be related to the virus itself, unemployment numbers. It could be related to some banter back and forth for the candidates between Trump and Biden specifically. Some other things to keep in mind are trade tensions. So China, trade tensions with the US have kind of been in the background because the pandemic has taken the forefront of the media, but we do still have underlying issues with trade tensions with China, and we don't know the outcome of that yet. For specific companies, not just globally, but here in the United States, we may and would expect, to be honest with you, uneven recovery. So you've had your haves and have-nots during this period of time. You have your companies that have flourished extremely well, hitting new market highs like Amazon, because people were restricted to really their homes, their sofas, and using electronic devices to order things. And you have your have-nots, and retail, actual brick and mortar stores are taking a hit. We've seen an increase in the number of bankruptcies with large retailers that we've all used during our lifetime. Think of Hertz Rental Car, J.C. Penney, Neiman Marcus, just to name a few. Very large companies filing bankruptcy protection. We would also expect to see corporations continue to cut dividends, if not eliminate them. We would expect to see additional bankruptcy filings. Interestingly enough, there's been an increase in the number of domestic violence cases and divorces as well, as we're spending more time with loved ones. Lasting effects of the policy response is also something to keep in your back of your mind, but it's something that's going to come forward in the future, meaning what happens with all of this additional debt that the government is shouldering as we infuse money into the economy by putting money in our pockets. That is something that's going to be considered and ultimately will be dealt with by future generations and subsequent presidents. Even if Trump is reelected, we would expect to see the results of this massive stimulus that we've just experienced be shouldered by future generations and future presidents. We will also expect to see continued volatility in the market, not just because of the election, but primarily because of numbers as they come out. Some of them I alluded to earlier in the conversation, but that continued bumpiness will continue. So expect volatility and expect to see in your portfolios movement, whether it's up or down in either direction. It's going to move. It's not going to be stagnant for a while. It's not going to be consistent movement in an upper direction like we saw from 2009 to 2017. It's going to bounce around. The last phase that I wanted to talk with you all about today is recovery. So what does that look like, and what is the time frame, at least from Edward Jones' perspective? I hop on multiple Zoom calls and virtual meetings every week just to listen to different economists so I can get everybody's perspective and a general consensus on what the thoughts are for recovery. So I mentioned some earlier. As consumers get back to work, a vaccine is available, mass distribution widely globally, and people get back to work and feel more comfortable spending money. The economies will come back, since we're 70 to 75% of what pops up our economy, at least here in the United States. We would expect the return, and if I have to assign any shape to it, I would say more similar to a Nike swish. Very closely to the letter U in our alphabet. I think, and personally, based on the numbers that we've seen, that March was the low. Of course, we've been shocked before. No one expected a pandemic either, but we're slowly moving in the correct direction. Throughout the rest of 2020, the markets are going to continue to be bumpy. They're going to move up and down, some days larger than others. Just 2 weeks ago, we saw a 7% pullback because Jerome Powell said we're keeping rates near zero for an extended period of time without giving us a definitive time frame. We're looking at recovery, meaning consistent movement in an upward direction in markets towards the latter part, last 6 months of 2021, and as we pull into 2022. But some of the results of what have occurred, meaning bankruptcies, even for your small business owners that may never come back into business as they once were, and some jobs being permanently eliminated. We took quite a long period of time to recover from what happened in 2008, 2009 as far as unemployment is concerned. But if we look at what happened in January, unemployment numbers were below 3%. We would expect 2020 to end with unemployment numbers hovering somewhere around 10%, which is massive unemployment still as the market recovers. We expect GDP to continue recovering. At the end of Q2, I mentioned earlier, we would expect an annualized GDP to be down somewhere around 40%. We would like to see GDP come somewhere, anywhere in the positive territory as we near the end of 2020 this year. Well, it's likely, I mentioned, to take several years to recover to reach pre-pandemic levels. Just because the economy and the market was doing exceptionally well for so long, meaning 11-year expansion, the longest in the United States history. To give you some numbers, just so you have an idea of how much we recovered from the 2008-2009 mortgage crisis, in that 11-year period of time, the S&P gained 529%, or an average of about 18.3% a year. So if there's any reason whatsoever for me to say you guys should stay the course and stay invested, that would be one huge reason, because markets always recover. The question is, how long do they take? And I'll give you an idea of a best trading day and a worst trading day to give you an idea of why to stay invested. For the S&P 500 year to date this year, the best trading day in one single day was 9.3% on March 13th for recovery. The absolute worst trading day was a 9.5% loss the day before on March 12th. So one day apart. Worst trading day, best trading day so far in 2020. Good reasons to stay invested. I did have some things to expect. Just generally speaking, I've already alluded to some. As we move forward, expect nasty numbers or deteriorating numbers at the end of Q2 when you see them come out or hear them in July for what has occurred pretty much the last 3 months. Continued unemployment claims, I would expect that they would continue to decrease, but people are still going to be filing for unemployment. An increase in the number of bankruptcies, so I wouldn't be surprised if you see additional large companies filing for bankruptcy. I alluded to some earlier. We can throw J. Crew, Diamond Offshore Drilling, Stage Stores, Gold Gem, Pier 1, Lord & Taylor, to name a couple of extras. The Congressional Budget Office expects GDP to decline 40% for Q2. That's an annualized number. It is the largest quarterly decline since the Great Depression. More volatility, I mentioned the periodic setbacks, a recovery similar to the Nike swoosh I alluded to put some realism in play here, optimism for recovery, but realistic expectations for volatility. Closer to home, oil, that's a big one on our minds here in Texas. I've had quite a few clients laid off in the oil and gas industry. You've seen numbers as of late, I'm sure, if you're keeping up with crude oil prices. Last I looked, it was $40 a barrel, moving in the right direction. If we remember what happened in 2015 and 16, it was an oil issue here in Texas. A lot of companies didn't come back, specifically those subcontracted companies that serve the oil and gas industry. We're seeing that again, and I would expect to see that a little while longer because it takes a while for oil and gas to come back. If you think what's going on in the market, some of the hardest hit industries were associated with travel. So airlines and cruise ships, cruise lines. Huge opportunities to get some money to work in those industries. They're going to be very slow to come back because what's hinging that or holding that back is our comfortability with getting back out there and traveling and being in enclosed, confined spaces around a number of people. So a little bit of recap of the 4 phases here. We talked about repricing. So what occurred initially, refooting, did we find the bottom? We think we did. Reopening, which is where we are now, and then recovery, which is coming. Book-ended recession that we're in started with a virus and hopefully will be ended by a vaccine. Some actions to consider, because I mentioned that I wanted to share some things, and I have a baker's dozen. So if you've got a pen handy or if you have the ability to replay the recording, you might want to jot some of these down. So these are some opportunities for you to look at. Generally speaking, when a recession occurs, we have 3 choices of actions that we can take. We can either join the panic and make emotion-driven decisions. We can stay calm and stay the course and let your goals be your guide for your money and what you ultimately want your money to do for you. Or you can be bold, and be bold is where I like to be. And that means if I've got money sitting on the sidelines or excess cash above and beyond my emergency savings account, then I might want to lean into equities and growth-focused companies so I can get that money to work because we know recovery occurs and the markets recover and rebound and set new highs. They always set new highs. It's just a matter of when. So my list of 12, consider fully funding your IRAs. For those under the age of 50, you can contribute a maximum of $6,000 for 2020. You still have the ability through mid-July to file your 2019 taxes. So if you have not filed those yet, you could make 2019 contributions. If you're 50 or older, you have that nice little extra 1,000 catch-up contribution you can do. So that's a total of 7,000 for you all. The second option you could take advantage of is Roth Conversions. So if you've been laid off this year and you're in a lower tax bracket and you have a lot of money in tax deferred accounts, think 401ks or traditional IRAs, you may consider converting some of that money and moving it into a tax-free bucket or pool of money for future use. Number three, tax loss harvesting. So if you have losses in any of your portfolios and your income is high this year, or you have some high earnings and you may want to sell something, you can use up to $3,000 of losses each year to offset some of your gains or some of your income. So that's something to consider, and I'm going to defer to a CPA on that and Roth Conversions. Please consult with whoever you do your taxes with. If you're not currently using someone and you wish to do Roth Conversions or tax loss harvesting, please reach out to a CPA to make sure the numbers make sense for you. Number four would be to rebalance your portfolio. Take a good look at it. You're probably out of balance. If your comfort with risk says that you should be in a blended portfolio, either 50-50, meaning 50% doing the work for you, 50% like the airbag in your car, or some variation of that blend of assets, you're likely out of balance. Fixed income is probably, if you were heavy in that, pulled you up. So you're probably closer to a 60-40 blend if you should have been a 50-50 blend. So look at rebalancing to get yourself back in your comfort with risk. And you also want to look to make sure you're diversified. I don't believe in having your eggs in one basket for any type of investments, even if it's the best investment on the planet, because everything that goes up eventually comes down. Think Enron. That's the biggest example I can give you. Number five would be to increase your 401k contributions at work. If you can afford to, if cash flow allows it. If nothing but ensuring you're getting the company match, at least ensure you're contributing enough to take advantage of the company's free match, which is free money for you. Number six would be upgrade to quality investments. So along the same line of ensuring that you're rebalancing to stay within your comfort with risk and you're diversified, is making sure that the quality of the investments that you're in haven't changed or deteriorated. One way to check that is Morningstar, or if you work with a financial professional or advisor, reach out to them, ask them to screen your portfolio and see if any of them have dropped in quality, quote unquote. Number seven would be systematic monthly investing. In the investment world, we refer to that as dollar cost averaging, where you drip a little in every month or every week or whenever you can afford to, or cash allows you to do that. But essentially that reduces and can eliminate the timing issue. Everybody always asks, when is the best time to get in the market? Well, I'll tell you, most recently, that was March 23rd. If you had money sitting on the sidelines then. But dollar cost averaging allows you to invest periodically over time. So you're buying sometimes when the market is down, sometimes when the market is up, and over the long term, you end up paying less. Number eight, consolidate old or outline accounts that you may have to simplify things for you. So required minimum distributions in the future when you turn 72, to reduce the number of 1099s that you receive in the mail, which will make things easier for you if you do your taxes, or for your CPA if you have someone do your taxes for you. And if you consolidate assets that are outlined in various different investment firms or financial institutions, it helps you ensure that you're properly diversified across all of your portfolio, your entire portfolio. Number nine would be a good life insurance review at this period of time. I mean, the pandemic kind of smacked us all in the face. Really good time to make sure you do a life insurance review. Multiple calculators are out there on the web. Generally speaking, you add up everything that you have of value that you would leave to heirs, you subtract insurance and accounts that you have. But you can go to edwardjones.com, type in life insurance calculator and use ours. It takes less than 5 minutes to do. But you want to make sure you have enough life insurance to do what you want life insurance to do. Generally speaking, there are a couple of reasons you have life insurance: to take care of those you love if something happens to you, put kids through college or help them get through college, pay off any existing debts so you don't shoulder someone with debts if you were to pass away. So keep those things in mind. Number 10 would be a good beneficiary review. So looking at your checking accounts, your savings accounts, 401ks you have at work, or 403bs, 457s, whatever it may be, traditional and Roth IRAs, simple SEP IRAs, wherever you can name beneficiaries. And some estate planning attorneys might not agree with me on this. I prefer to keep everything out of probate that way it saves your heirs time and money. It just kind of makes things simpler. If you can name beneficiaries, you always want to name at least 2 levels, primary and contingent beneficiaries. Keep in mind, if you have joint accounts, you can actually name beneficiaries on joint accounts. Generally speaking, in Texas, because we're a common property state, accounts are set up with joints with rights or survivorship, meaning if something happens to one other owner, the other owner continues using the account normally, but you can name primary beneficiaries. So for example, husband and wife could name their kiddos as primary beneficiaries so that that particular account would stay out of probate as well. Actually, in the state of Texas, you have the ability to name 1 level of beneficiaries on vehicles, and you can also name beneficiaries on real estate. You just have to have an attorney draw up the documents. Number 11 would be to look at refinancing debt that you may have. So if you have a mortgage rates are at historic lows. Last I looked last week, they were around 3.11% if you have perfect credit. But of course, you'd want to reach out to someone who does mortgages, either your lending institution or a mortgage broker, because you need to make sure that paying the cost of closing makes sense for refinancing. So something to consider. You're not also only considering mortgage debt. You should look at unsecured debt. Any personal loans you may have, you may be able to refinance. Generally speaking, in the world of finance, your credit unions are going to have lower rates, APRs, annual percentage rates. You also may consider refinancing auto loans if you have any of those right now. And then number 12, I thought was fun and timely. So I mentioned earlier in the conversation that the travel industry probably took the worst beating in the economy as far as one of the 11 segments that you can invest in our country. And so booking vacations makes a whole lot of sense right now because ticket prices and cruise ship prices are affordably low, not just to invest in them as companies, but to buy your vacations over the next 6 to 12 months if you think you'll be, 1, comfortable to get back out there on an enclosed vessel, and 2, if you think that the economies will be that advanced as far as reopening by that period of time. Dr. J, that's my 4 phases to recovery.
Well, Shane, that was just really interesting. And we've got some really interesting questions, so as we usually do. But one of our listeners asks if you could speak a little bit more to this issue that the market cratering was caused by a pandemic and not financial. So as we look at market volatility, do we have to see a vaccine before we can expect some return to stability?
So the 2-pronged question, yes, I would say what that all boils down, I mean, that was 2 parts to that question, but what it all boils down to is consumer confidence. Remember, I mentioned twice that consumers in the United States are 70 to 75% of our economy. So when we feel comfortable getting back out there and shopping and spending some money, because we've all, as of late, because of what was going on with a lot of unemployment and a lot of uncertainty with comfortability around getting outside of our houses and our comfort zones, have hoarded our money, because we didn't know if we were going to have the ability to pay rent, mortgage, car payments, or what have you in the coming months, because there was a lot of uncertainty and still is around job security in certain industries specifically. So as consumer confidence goes, generally speaking, the markets go. And markets and the economy are actually 2 different things. The economy usually lags the markets. The markets are usually forward-looking and forward-telling. So that massive drawback from the February highs to the March 23rd low was because we didn't know what was happening. There was a lot going on in the news with how does this virus spread? How can we protect ourselves? And until, in my opinion, and a lot of economists' opinion as well, and our opinion as Edward Jones, until there's a vaccine, whether we get it or not, until there's a medical advancement available on mass distribution and mass scale, that impacts our confidence and our comfortability with returning to what we knew as pre-pandemic normal.
Interesting. Well, you know, you talk about our economy being so driven by consumer spending. So should we spend? And what's your general advice on personal budgeting and finance at this point?
So the first part of that is you have to spend with what you're comfortable with spending. Most people don't like the dirty word budget. But really what I'm alluding to when I say your comfort is, are one or both people in your household, if you're a two working person household, actually at work? Or are you living on one person's income right now? Or are you living, both of you, or one, if you're a single family home, on just unemployment? So that comes into play. Two, I wouldn't want or encourage anyone to rely on debt, meaning credit cards, unless it's absolutely necessary. So I'm certainly not encouraging anyone, go out and spend money. And Shane said, use your credit card. That is absolutely not what I'm saying. You have to spend within what you're comfortable with. No one knows your finances better than you. And if you need help working those out, seek financial advice. That's where a financial advisor like myself comes into play. CPAs can help you as well. Consumer credit counseling can help also. So keep those things in mind. And then the second part of the question was, remind me?
I just flipped. In terms of spending and how that actually impacts the economy, given how much of the percentage is actually attributable each year to personal spending.
So if you think about the economy in general, it's really just a big circle. So as you and I consume as consumers and buy things, we're buying from companies who are manufacturing things, which employs people, you and I, to make the products. And we have this global economy now where we're getting parts of the things that we buy from different countries, not just the United States. So we're very intertwined. The world is a lot smaller now than it used to be. It's about the size of a pea compared to Jupiter, like it used to be, when we didn't really have that intertwined necessity for parts from all over the world for the different things that we consume here in the United States. So getting people to work at those companies, they make money, they buy things, they put money back in the economy. And really, if you think about the markets, there's three indexes that we pay attention to. The Dow is the big one, but it's really only 30 large companies. The S&P 500 is 500 companies that are more diversified than the Dow, but the Dow is the big one. The Dow is the one most people refer to when they're referring to the quote unquote markets. And then you have the NASDAQ, which is tech heavy, and it's more than the S&P. It's a large number of companies. So generally speaking, more people pay attention to the Dow and call it the market, but the S&P 500 would be more diversified in general. So if we're buying from those companies and they're having revenues and profits, their numbers are going up, then you're seeing that economic indicator in the form of a market indicating that the market is actually doing well and the economy is improving.
So relative to spending, we have a lot of local small businesses that are represented in the various chambers and the Area Economic Development Council. And I wonder what your thought is on buying local. Does it matter?
This just came up. So I went this past weekend to our local Walmart because there aren't very many places to shop where I live. I do a lot of shopping here in Katy also because my office and a large part of my clientele are Katy, Greater Houston. But the sales tax revenue from companies where you shop stays in those local communities. And that matters because those sales tax dollars get put to use in the community in which you're making your purchases. So yes, it absolutely matters. I just read some statistics this week about the state of Texas sales tax revenue being down from the month of March to the month of May, and it was millions and millions of dollars. And Texas is one of the strongest economies in the union. So yes, shopping locally absolutely matters. And what matters even more than just the sales tax revenue is our small business owners, because that is their livelihood. Small business owners generally live and breathe their companies and what they do every day. And they're there morning till close, 5, 6, 7 days a week, because they're passionate about it. They got into it because there was a need or there was something that they were really passionate about doing. And if you love what you're doing, you're never working a day in your life. That's an old adage we all know, we've all heard. So yes, shop local. Every time you can, shop local. Your money does matter.
I'm sure that our small businesses, local businesses will be very happy to hear you say that. Another listener has asked about the real estate market. What does Edward Jones see in terms of home sales and commercial real estate?
Commercial real estate is one to watch on many fronts, primarily because brick and mortar had been slowly peeling away over the last couple of years as e-commerce has moved up in popularity. And what brought it to the forefront, it being commercial real estate, as much as Zoom, which most people had never heard of, or Teams, those types of things, this new way we've had to adjust to doing business in our daily lives now. Commercial real estate is a concern because how well will retail, physical brick and mortar businesses do in the future? I would say there's an argument for it because I'm one who likes to go in. I like to touch. I'm a tangible individual. I want to see, I want to smell, I want to be able to return it somewhere. I want that local relationship. I want to get to know the business owner or the employees that work there. So I'd say there's an argument for it, but I will say it is one to watch. Real estate in general, numbers have improved. So builds have improved. Existing home purchases have improved over the last month. New home purchases have also improved over the last month. Specifically. So there's a lot of moving and shaking. And I can tell you, with having read a lot of articles as of late, what we're seeing is an interesting exodus from major cities. Because of the new ways of working, and a lot of our major companies saying, well, we're okay with you guys doing virtual meetings via Zoom or Teams or what have you. No longer really have the need to meet in person physically by hopping on a plane to travel somewhere. So if you can work remotely, and more companies are going to allow that, and some have said now indefinitely going to allow it, that begs the question of, do I need to stay in a city to work for a specific company? I mentioned I live in a small town 30, 40 miles west of Katy, and I can tell you home prices in real estate have gone up significantly in the last year because people are interested in getting out of the city, having more land. Your money goes a whole lot further because you can get a much bigger house for the same. You can get a mansion where I live for the price of some of the homes here in Katy. And it really is amazing. So real estate is moving and shaking right now. A lot of the reasons that people get into real estate, physical real estate, is for flipping to make money. You can do the same thing in investments. And the reason generally people would get into real estate investment trusts, they're called REITs, or exchange traded funds or mutual funds, or individual stocks with real estate, be it commercial or residential, is because they pay, generally speaking, decent dividends, kind of like interest that you'd earn on your savings account. But savings accounts and CDs just aren't really paying anything right now. So if you want anything north of 1%, you have to look elsewhere.
Wow, so interesting. Another listener asks, so if it's timely to buy or schedule our vacations, are prices going to stay low for the foreseeable future, or am I better buying my ticket now, even though I'm not quite sure that I'll be ready to travel in 6 months?
So there are a couple of caveats to buying. I like number 12 because it sounds good and it feels good to think about vacations and getting to a little bit of normal and getting out of our what we've been confined to, be that your house or to and from your office and maybe the occasional grocery store shopping. But yes, I mean, recently I just got back from Colorado. Friends have a cabin there. We were going to fly. Our flights changed 3 times. So you have to be prepared and be flexible with travel, because if the planes aren't filling up, the airline's going to cancel it and move you to a later flight so they can build up a number of people to fill up airplanes. So it makes sense for them financially as well. So you're going to have to be very flexible. And we don't know what 6 months from now is going to look like as far as how big of a second wave. Will there be a third wave? Will we have a vaccine? What medical treatments will be available? So you have to be flexible. And I would make sure if you get tickets, you buy the refundable kind, or you buy trip insurance, just to make sure you're protecting your investment in your future vacation. Because again, in the investment world, we don't have a crystal ball. We don't have a crystal ball for the future at all. We can, have processes and thoughts about where we think things are going to go, but no one knows beyond any reasonable doubt. So if you do it, make sure you protect yourself with refundable tickets or trip insurance.
Great suggestion. A listener asks, you talked a little bit about the election and the polarization of the electorate. Are we to see ups and downs now through November, or expect the big whammy in November? Can you speak to how the politics of the national election are going to impact us?
Yes. So if you think back to 2018, it was midterm elections. There was a lot of concern about flipping the House and the Senate during midterm elections. And we saw a lot of market movement in October, November, and then of course in December of 2018 after the elections, and we knew the outcome was when we had the large pullback that particular year. It was the only large pullback in 2018, but the markets did get bumpy leading up to midterm elections. I'm going to say the markets are going to be bumpy for the rest of the entire year because of the 2 issues that we're aware of. 1, the election, and 2, what happens with advancements in medical treatments, potential additional waves of the coronavirus, COVID-19. But if I said specifically, let's not think about the pandemic, what will volatility look like because of the elections? The polarization of our country is, I would say, as much, if not more divisive than it's ever been, at least in my lifetime. And I would say that we should expect a lot of nasty mudslinging, probably some of the worst that we've ever seen in recorded history, just because we're so polarized. I would say, I actually spoke with a cop this morning who said that we're seeing rioting right now for the Black Lives Matter movement. If the election doesn't go the way either party really wants it to go, does that mean additional rioting because the specific party didn't get their outcome? Here's what we know about elections in the market. Historically speaking, it doesn't matter which party is in power, the markets always perform well in the long term. And there's a lot of statistical science. I'd be happy to share it with you one-off. And anybody who's interested, you can shoot me an email. Very simple, Shane, Shane.Theriot, Theriot @edwardjones.com, or give me a call, 281-391-6137. I'd be happy to talk to you about the politics of investing. A lot of people think if the Democrats are in the party, the economy flourishes. If the Republicans are in the House or the Senate or the president, the economy flourishes. And the answer is yes to both. The economy always does well, regardless of what party is in power in Congress or the president.
How interesting. Well, that's gives us all hope, no matter which side of the aisle we may sit. So thank you. The last question that we've got on the docket at the moment, anyway, is about refinancing debt. And a listener writes that they've heard that many institutions are not writing new or rewriting new loans at the moment. Can you speak? Is refinancing possible right now?
It is possible. You just have to find a lender or a mortgage broker that is actually doing it, and that is an issue. So
Oh, it is. Okay.
it is an issue. Yes, there are some institutions who've said that they are not going to do refinances because it hits their bottom line, which I mean it does, because you're refinancing your debt to lower it
Oh.
for yourself. So if your annual percentage rate goes, making up numbers here, from 5% on a mortgage, and you refinance it and it comes down to 3.11, well, that difference in APRs is money in the pocket of the lending institution that's refinancing your debt, or money out of it, in other words. So yes, there are mortgage brokers and lenders out there that will refinance it. I have also heard that some banks have stopped home equity lending because those rates are low. And the reason rates are low is because part of the stimulus, Jerome Powell, the Fed, the monetary stimulus that we've seen, was lowering lending rates to zero. Well, that lending rate that we all hear about on the news or read about is how banks borrow money and shuffle money between themselves. And if the rates are low, that means that they can lower the rate that they're lending money out to you and I as consumers, which the government wants to do so that we're out there making purchases. Now, the government doesn't want you to refinance. They want you to go borrow money to buy something else, generally speaking, because consumer spending runs the economy. But it's a great time to take advantage of refinancing debt if you have higher annual percentage rates on anything that you may owe for, your liabilities.
Wow. So last question from me. What should we be reading, or where should we be looking for authoritative information that is balanced and really non-emotional? So what's your best recommendation for resources so that we can keep informed as we're managing the family budgets, the family checking account?
Sure. So there are a lot of resources out there. I actually subscribe to two, and I get an email every morning. It can be a little overwhelming. I try to read as much as I possibly can. I'm like a sponge. I love information. One is called The Morning Brew. The other one is called The Hustle. Those are good tidbits. I like that they both occasionally put a blip in there about the markets. I work at Edward Jones, so I'm familiar with our market strategists. I would say I'm biased that we have a couple of the best in the world. Nila, Richardson, and Craig Fair will put out a weekly market update. Every week it comes out. I email it to whoever I have emails for, but you can certainly go to edwardjones.com, and in the search function in the upper right corner, type in weekly market update, and it comes out every weekend, and it's an update with what happened the prior week and a little bit of outlook for the future week coming. If you like to be in the know, I know that I get the five updates from Merrill emailed to me every week also. I like that they occasionally, one or two of the five is podcasts. So you can listen if you prefer like a 2 or 3 minute recap of the market audibly rather than reading. So there are a lot of resources out there, but look for reputable resources. I don't particularly care for reading anything that is politically one way or the other, or I don't believe in extreme economists to where we're falling off the cliff or the world's recovering tomorrow. I want the best of kind of all the views so I can form my own opinion.
Great advice, Shane. Absolutely great advice. Well, on behalf of the Return to Workforce Safely Task Force, I'd like to thank you, Shane, for the time and energy of not only coming today, but preparing. It was very informative, and, you know, it's not every day that we get somebody of your caliber that can speak to us and really help keep us informed on what's happening in the economy as it relates to our own personal situation. For those of you who are interested, we have recorded our session with Shane today. Give us about 24 hours and it will be posted on the Return to Work Task Force landing page. And we do have Shane's email address and his phone number available for you for those that are interested. And we'd certainly recommend you reach out to him if you have questions. The other thing we'd like to remind everyone is that as we go into phase 3 of restarting and reopening the Texas economy. As the governor said yesterday, it is advisable to wear masks, not only for yourself, but for others, to remember the 20-second hand washing. And if you want to know how long 20 seconds is, sing a stanza of Happy Birthday or the music of your choice. And really, mask, hand washing, and social distancing. Those are the 3 advisories that have been coming from the CDC since the inception, and the governor reinforced that yesterday. We all take responsibility for our own behavior and enforce those measures, then we are likely not to have to drop back. And what we want most of anything is to avoid a second wave. So mask, social distance, and hand washing. We will encourage you to keep in touch with us at the Return to Work Task Force landing page. We have programs every Tuesday now through Labor Day that have been planned each week at 2 o'clock. I will remain your faithful host and wish all of you a great week. And as my hiking buddy likes to say, have a good day and good health. Thanks, everybody, and we'll hope to see you soon. Bye now.
Thanks, Dr. J. Appreciate it.
Bye-bye, Shane.
Bye-bye.